Good morning, everyone. I'd like to call this meeting to order. Can I please have a roll call?
Treasurer Joseph.
Here.
Gene Rondo.
Here.
Mark Carullo.
Here.
Michael Cicerone.
Here.
Brian Daniels.
Here.
Matthew Howard.
Here.
Jim Lee is not here, excused. Elena Burgess.
Here.
William Murray.
Here.
Claire Jules.
Here.
Andrew Nada. Here. Ellen Palazzo.
Here.
Sandra Paquette.
Here.
Dr. Shaw Hughes.
Here.
Michael Toohey.
Here.
We have quorum.
Thank you very much. All right, we'll now seek the approval of the drafted minutes of the February 18, 2026 retirement board meeting.
So moved.
So move.
Second.
All in favor?
Aye.
So move. Thank you. Well, I want to take the moment to recognize Claire Newell for her service to the board. Today is her last board meeting. And so I really wanted to indulge all of you in her very successful career. Not only 38 years of service, but also being on the board here since 2012. So I really want to take the opportunity to recognize her, to thank her. We'll have a little blurb in the compass, just recognizing you for your work, but just want to say thank you. The little time that I've known you, you've been straight shooter, very honest, but more importantly, I recognize your real hard commitment to the board and its members, and I want to thank you for that.
Thank you.
I'll open it up for any other board members if you want to say anything. Some have been with her just the whole time, but
It's been a pleasure. We're gonna miss her.
yeah.
And the best in your retirement. So you come back.
Thank you, everyone. It's been a pleasure. I've learned a lot. I met some great people and worked with great people over the years. It's been nice to see Brian Daniels, and we had Tara. I mean, I could go on and on. So thank you. And I hope you all, wish you all well, and what's going on with the election?
Good,
Okay,
thank you again.
thank you.
Thank you. All right, moving on to the executive director's report.
Okay. We'll do change presenter. Do Justin Maestro. And then I have a few remarks here. So, we're usually on second Wednesday. But sometimes we have to adjust, so we were late in February and it's a short month, so it seems like we were just here. And then, a couple other days we're not, it's like a Wednesday. We're working around the actuary's schedule. So we're on the 20th, as we talked about, not the 13th in May, Veterans Day, the second Wednesday. So it'll be later in November. And then for the actual evaluation, we always have to be a little bit later in the month in December. So usually Wednesday, but to have both a short month and a second Wednesday, and then have the intervening largest storm ever, 2 emergency days, 2.5 school vacation days, and 5 days of snow days. Well, a lot, it feels like we were just here. So what we also, just as a follow-up, had a TELUS technology center we discussed last week on site for 2 of those days. So I'd like to echo the treasurer's marks, thank her infinitely. The primary, I'd like to welcome Brian back to the board, but in a different role. So you see, Joe Codiga did a Herculean effort representing the state, talking yesterday at the rating agency's calls. Board chair, probably a little bit too humble. He was also down in New York, did over 6 hours of the calls. Justin and I were on, and I thought it'd be worth the board knowing that my only role was to say that as new executive director, we were well managed when I inherited it, and we've been long paying our bills and moving in the right financial direction. So I hope I represented you well by saying that. So our primary agenda item in my report is Justin Maestro. He's going to talk about 2 things. He's our chief investment officer. He's brilliant. He could go for a whole 8 hours. We get all of our continuing education for the entire year. I saw his deck from last year. It was extensive. And I've asked him to not go for that long.
Okay.
And to really focus in on two things. One, it's I think an obligation of ours to understand like what's our situation, like how much do we have? So he's gonna look at our year-end performance, like what happened last calendar year. But second, rather than put it in the context of like everything you could possibly know about investing, I want him to do it by walking through the state investment book that we include in our board every month. And the reason for that is, I think, a kind of a goal of these small trainings is to make sure that we're all getting to a shared vocabulary. And one thing that I'm going to be thinking about both during his presentation, but in each of the trainings we have coming up, is I would never say we need less information, like we have to give the investment book plus more. But you know, this is a little bit of message of something that needs to be printed. And so is this the only thing we need? Is it actionable? Is it understandable? Like what things are we checking in it? And so us all kind of like coming at it of like, all right, let's figure out how to use this book really effectively for our time. Institutional investing is a different thing than personal investing. And so understanding how he thinks about it is really crucial to us doing our job in terms of being stewards of this. So that's the goal. Before he goes on his well less than 8 hour training update, I do want to just kind of close the loop on a few things I've said in the last couple meetings. So first off, we have been working with the ops team and they have made a suggestion on new badge policy. So we'll be discussing that in April and kind of probably taking photos. I mean, it's just someone. Then we will have badges that align to our timeline and you know, stricter set of approvals. In April, we'll be getting Justin Miller's here, a cyber training from Justin, and also looking at a few of those contracts. In May, we will have both some training from the actuaries on methodology, but then primarily be reviewing the experience study. And then possibly in June, kind of depending on time, we're gonna get a training on our kind of software and business systems. Like it's really like the nuts and bolts that Eric Mata here, brilliant guy. I think it's important for us to understand how the day-to-day works. And then we don't have a set time, but we'll have Tia come in and review the defined contribution plan for us sometime after the close of the fiscal year. Also, it's worth noting, you know, in this incredibly short month where we kind of jammed so much in, I'll be transparent, I'm a little bit administratively behind due to all those things. We are making progress on the board election as Sarah asked. We're on track to fill it well within the rules of the board as they're laid out. We do need to reconstitute a few of our committees. And so we have a new Ryan Daniels here is on behalf of Joe Codiga, who was working so hard yesterday. He really did great. And Elena is here on behalf of new director Birdie, or acting director Birdie. So we have some change in board membership, and that will cause us to slightly change some of our committees, and we will update you on that over the next month as we kind of finalize that. But I assure you that all the work is being done and we're well on track to follow all of our rules. So look for updates on all those fronts. And I will now turn it to Justin for a performance review and a little bit of training.
Yeah, thanks, Andrew. First, I'll introduce myself, Justin Maestro, Chief Investment Officer. I've been here for about 8.5 years now. I'm very happy to see that there are so many familiar faces at the table. I think when it comes to managing a very large pool of capital that's important to so many Rhode Islanders in ways we cannot even imagine, strategic continuity is of the utmost importance. So to see that continuity is a characteristic of this body makes me really happy to see. I'll also say it's important to note I'm a member of the system. I'm not just the chief investment officer helping to oversee how this capital gets invested. I'm an employee of the state. So I can truly appreciate the work that takes place here, which is no doubt thankless, given you are volunteer board members after all. But I can appreciate that you're advocating for really good people who have dedicated their lives to public service, including my own. So I appreciate everything you do. I know how thankless this role can be sometimes. Additionally, I'm gonna share something personal. which I realize is very risky because this is being recorded. I understand that all the recordings are now stored and available for everyone to see. So, really dangerous. I've already, the train left the station. I can't turn it around now. But when I first got to Rhode Island 8.5 years ago, it's because my wife forced me to. I didn't say, hey, look, this seems like an attractive opportunity. She's from New England. We were living together in New York, the big city. And she said, Justin, when you're searching for jobs, why don't you cast a wide net and include New England in your job search? I said, fine, okay. I stumbled upon an investment role in Rhode Island, and my first time visiting Providence, actually for the job interview. And candidly, I thought I'll be here for a year, maybe 2 years, and then I'll move up. I'll convince her to move up to Boston. I need to be in a big city like I was in New York. But it didn't take very long. I've fallen in love with Rhode Island. My roots are deeply planted here. I have 2 young children who are in the school system here. And we're very happy to be Rhode Islanders. I'm a Rhode Islander now through and through, despite what my parents may think or tell me. But I'm committed to this place. I've also obviously fallen in love with the mission, just like all of you. This is an opportunity, I think a rare opportunity, to use my background in education to help serve and make a positive difference. Oftentimes investing is associated with greed and evil, rightfully so. So I'm really happy that there's a role like this that exists that gives me the opportunity to contribute something positive. So I've been here almost a decade. Hopefully, assuming the treasurer wants to keep me around, I could stick around for a few more decades. Like Andrew said, I haven't presented to this body in quite a while. Actually, I know that to be true. I think the last time I spoke to you all was that retreat that Andrew was referring to, where I spoke for 2 hours. If I'm exceeding even a half hour today, please tell me to shut up. If you don't tell me to shut up, I'm just gonna keep going. I know it's been a while since we've been in this room. I made this comment last time, but I did notice once again the flattering view of my scalp. But I know that years have passed by because it looks significantly worse today than it did maybe 2 years ago. Anyway, with that, I'll jump into the content here. Andrew said that, he asked me, hey, can you just walk us through the SIC book? Help just bolster our understanding, because these books we publish on our website, by the way. They're presented at every single monthly SIC meeting. After they're presented, we'll put them on our website. So if you don't know how to access them, ask Andrew to show you how to do it. But I just want to help make sure that we all have a collective understanding, so we know how to actually interpret the information within these books. Now, we're continuously looking to just refine and evolve the way that we report. When a lot of numbers are thrown at you, it's hard to understand things. So we have been thinking about ways to streamline the reporting, create more actionable insights, use some color coding that looks probably a lot better than the color coding that you see on the TVs right now, to help just understand our different areas of the portfolio meeting their objectives. Is further review required, or are warning signals flashing that require us to further evaluate? Now, I'm not going to take you through a full training session. When we did the retreat last, we spoke about a lot of concepts that I'll probably bring up throughout the conversation. But one of those concepts is the investment policy statement. How many of you in here have actually seen or read our investment policy statement? Okay, I was hoping you'd raise your hand. If you didn't, I definitely would have called you out. But I'm assuming if no one's seen it, you probably don't know how to access it. But it's on the Treasury website. If you want after that, I know although you're an expert at the Treasury website at this point, if you want to look at that investment policy statement at any point, which I highly recommend, we can definitely circulate to make sure that you know how to access it. The investment policy statement, that really dictates the way that we, the SIC, Treasury investment staff, invest the actual portfolio. It outlines our investment objectives and philosophies. It describes the various parties and vendors who have a role in investing their portfolio and what those roles actually entail. It also, in greater detail than you can find in the SIC book, describes what our investment strategy actually is and how our assets are being allocated, asset allocation, which is the primary driver of investment outcomes, both from a risk and return standpoint. What asset allocation is, as a refresher, it's the mix of asset categories and your target investments to those various asset categories. What percentage of my portfolio do I want in stocks? What percentage in bonds, real estate, so on and so forth. All of that information is described in the investment policy statement, and how it translates into the SIC book is really this page right here that you see on the screen. This is, we call it the colorful strategic asset allocation chart. And it does seem like a lot. I'm looking at this now and already the wheels are turning. How can we simplify and make this a little bit easier for folks to interpret? The way that I think about this is, if you're thinking about a portfolio, it really is divided up into risk assets and diversifying assets. That's the simple way to think about it. The riskier assets are on the top of this page. The more diversifying asset classes are on the bottom of the page. Why can't we just invest everything in risk asset classes? You know, not only is this plan underfunded, but the plan is cash flow negative. We're paying more benefits every month that we're receiving in contributions. We have to sell assets on a monthly basis, whether the markets are up or down. So when we build a portfolio and blend together risky assets and diversifying assets, we're trying to achieve that balance between pursuing returns to help reduce the underfunding, while at the same time mitigating the potential impact of having to sell risky assets when markets are selling off or at low value. All of those objectives blend together into this asset allocation you see here. We don't typically view the world like a lot of other institutions out there, and that most folks have their specific real estate allocation. Let's just say they allocate 10% to real estate, 10% to or 40% to public equity, so on and so forth. We bucket our portfolio by function and role. So an asset class like real estate, yeah, we invest in a lot of real estate, but real estate comes in many different flavors. You have core performing real estate, stabilized trophy properties, and then you have more value add type real estate strategies when you're buying an undermanaged property, renovating it, leasing it up, so on and so forth. Those two strategies have very different risk profiles and thus will sit in different areas of our portfolio. I'll describe more about what that is in just a second. But the part of this page that's worth paying attention to most closely is the very left-hand column, functional bucket. And that's how we divide up our asset allocation. We have our growth bucket, which contains our risky assets like stocks, private equity, and that value add real estate that I was just talking about. And then at the very bottom of the page, we have stability, our diversifying assets, the assets that we expect to help us mitigate a variety of different types of risks. In between the two is income. Now, I would say income is somewhere in between risk assets and diversifying assets on the risk spectrum, hence that blue section being between growth and stability, but probably more closely related to the growth assets than the diversifying assets on this page. Each of these three major categories is further subdivided into additional buckets, which is column number 2, the aggregate asset class. So our growth bucket, for instance, is divided between public growth, or on this page, it's labeled global equity, that's publicly traded stocks, and private growth, which are non-traded strategies, private strategies. In the third column, you can see our target allocation, what percentage of the portfolio we want to invest in these asset classes. So for global equity or publicly traded stocks, our target allocation, according to that third column there, is 40%. Right underneath that, in the private growth bucket, which is private equity and our value add real estate, our target is 15%. Our income bucket, it's not further subdivided into an aggregate asset class, hence the word income being right next to income. I get that can be a little bit confusing since it's a little different for the rest of our allocations here. So I'll jump into the stability bucket, which is subdivided into 3 aggregate asset classes. There's CPC, the yellow category there. That stands for crisis protection funds. This is the allocation within the portfolio. Now it's a 10% allocation that's expected to provide portfolio protection in an extreme market drawdown, a crisis, not a protection, not a correction, an actual market crisis. Now, defining a crisis is a little bit tricky, but if you look at a historical scenario like the global financial crisis, the dot-com bubble, things like that, this is where we would expect this portion of the portfolio to materially appreciate in value when our risk assets are more than likely selling off and selling off sharply. There's the inflation protection bucket directly below that, mostly consists of real assets that will appreciate or expected to appreciate in value when we have unexpected bouts of inflation, as it happened we experienced a few years ago, and this bucket performed quite well. Then there's the volatility protection that consists of strategies that have lower correlations to risk assets like equities. So again, just top to bottom on this page, we're talking about the risky return generating assets in the green sections. And then this yellow, orange, and goldish brown vomit, whatever you want to call it. These are the more diversifying asset classes with income somewhere in between on that risk spectrum. You can see that the majority of our portfolio is allocated to risk assets. Our target to growth is 55%. Adding income, which is also consists of, I would say, risk assets, adds an additional 12%. So 67% of the portfolio from a dollar perspective allocated to more risk return generating assets. So if you're looking more towards the right-hand side of this page, you can see that each of those buckets I described, which I would encourage you to just pay attention to those broad buckets. That's what we consider to be that allocation decision. The implementation decision really happens in column 4, that asset class column that tends to be the widest on the page, where it explains what exactly goes into global equity, for instance, US equities, international equities, emerging market equities, or private, what makes up that 15%? It's private equity and value add real estate, as I had described, so on and so forth. The following column includes our target allocation percentage to those various strategies, what our actual allocation is, because we will deviate from our targets. Markets go up, markets go down, and asset classes move in different directions. So that pulls us away from our target allocations. And then we, on the very last column, report the difference. How far off are we from our target? Now, an important aspect of managing the portfolio is a concept of rebalancing. It's probably a term that you've heard before, or I've spoken to you all about, but we do aim to rebalance our portfolios. This is the act of moving our actual allocations, second to last column, closer to our strategic targets, the third to the last column on the page. Now, it's impossible to do this perfectly and rebalance every single month, because transacting and selling or purchasing different assets, it's price. It's costly to rebalance physically every single month. There are also asset classes in the portfolio with varying degrees of liquidity. Less liquid asset classes like real estate are trickier to actually liquidate on a frequent basis, like treasuries would be. So there's a lot of calculus that takes place, for lack of a better word, to make sure that we're actually efficiently keeping our portfolio's intended exposures intact. The way to really think about the.
Sorry.
Yep.
So I was just sitting here looking at this, and if this is a dumb question, I apologize. But the crisis protection and the volatility protection, right?
Yep.
Where's the line that separates the two, right? Because volatility protection one could argue is a portion of the crisis protection, right? So where's the line where it flips from one to the next?
That's not a dumb question. The lines, as is the case with all these asset classes, like are not black and white. Like there is some gray and some overlap, and we've had periods like 2022, for instance, where both stocks and bonds were declining simultaneously. The traditional 60/40 portfolio in fiscal 22 was down over 13%. Both volatility protection and CPC provided some level of offset to that drawdown and enabled us to only lose 1.5% during that time period. One of the reasons why that's also a very thoughtful question is, and I'll talk a little bit about our investment consultants and how we work with them, but our general investment consultant who provides guidance on asset allocation and broader portfolio strategy, one of the first items for consideration that was presented to the SIC upon bringing this consultant Makita on board was, hey, the crisis protection class, like we should really consider, this is really more of a relabeling or just a framing of expectations exercise. Some of what's in the volatility protection class, like absolute return, for instance, you really should be thinking about that collectively with the crisis protection class. Like there is potentially an opportunity to relabel the portfolio, if you will, or rebucket them. That's a later conversation. I'll talk more about what's going on at the SIC right now and some of the things we're working on in relation to the strategic asset allocation. But the line, it's tricky. Depends on who you ask. But the point is, I think both areas of the portfolio are expected to provide diversification to our equity risk. It depends on a lot of factors, just how much protection they're going to provide, if they're going to provide that protection, because at the end of the day, you can lean on historical data, but correlations are not stable. They will shift around. And assets that are uncorrelated in one market regime may become more correlated to equity risk in a different market regime. I don't know if that answers your question.
Yeah, no, it does. Thank you.
Could I ask like a leading follow-up?
Sure.
You just talked a little bit about, you could have a good couple of years that were highly volatile. So it's not a crisis, it didn't all go down, it's just, maybe geopolitical things cause wild volatility. And so even though we're net up, that's not as good as getting exactly our same return each year, right?
Right.
And so volatility different than crisis.
Yep, exactly. You much better answer than that.
I understood what you were saying. It's okay.
Thanks. So just a final comment on physical rebalancing and looking at this, because a lot of folks will look at this page and say, how can you be so far off from your target? In your US equities, you're 0.6% of the weight, and to rectify that, are you selling something to add more US equities to the portfolio? Generally, the way we think about it is twofold. One, because like I said, we have to sell assets every month in order to meet our benefit obligations. We're generally going to, again, depending on market conditions, there are other factors in play here, but we're generally going to look towards the asset classes that are over relative to their target and sell those to help fund the benefit payment. So that's a way to help move us back to target without, with efficiently trading the portfolio.
Justin, so
Yes.
isn't the private growth more long-term and you're kind of locked into that?
Yes.
So when you were saying that, if you look at that class, that's really not a class that you can access for liquidity.
So it's not a class that we can necessarily access for liquidity.
Right.
But I will say our private equity portfolio, for instance, is mature. And at this stage, it's actually producing more in distributions for the fund than we're providing in capital contribution. So it does generate some level of cash flow. But yeah, adjusting that 3.7% overweight that we currently see, and it's going to be a much more gradual process.
I think a couple of years ago, it was stated that was going to be a long-term process to try to get
Yeah.
out of some of that, get it rebalanced.
Yeah,
right?
and we've made some progress. It was that overweight was as large as around or closer to 6% at one point.
Yeah.
It's coming down. Now, when you see it as an overweight in an illiquid asset class like that, you have a few options. You can try to sell your stake, your LP interest in a private vehicle on the secondary market to another institutional investor who may be looking to add more private equity exposure to the portfolio. Problem is that market, it's not very liquid. When you're selling, probably gonna have to take a nice discount on your net asset value. In fact, we've been on the other side of that trade before and have made a few secondary purchases, buying LP interests at cheap discounts.
Value, yeah.
Yeah, a tool we've used sparingly, but have used in the past. The other option is to just stop investing in those strategies altogether, just cut your commitments. The problem there is generally the periods where you're overweight private equity, for instance. Those are the vintages or the years in which committing to private equity is most beneficial. And this fund has made that mistake in the past. In the global financial crisis, when equity markets sold off, and this fund became very overweight to private equity, the investment office, the SIC, just stopped committing altogether. I think it's 2008, 9, 10 vintages had zero private equity exposures. Those are some of the best performing private equity vintages out there. So missed opportunities. A lot of performance on in private equity world is dependent on when you're actually investing, or vintage year as they call it. And for us, we want to make sure that we're allocating as evenly as possible across vintages, so we don't make the same mistake that was made around the global financial crisis. Now, instead of going all the way to zero, so there's sell, shut off the commitment activity altogether, or gradually slow the commitment activity. And that's what we've done as our target commitments across those liquid asset classes have come down over the years, and we've seen that our overweight has started to come down as well.
Where are you migrating that? As you're growing that down, is that getting migrated equally throughout the rest of the chart? Or is it staying in the growth and going into global equities?
So big picture,
Yeah.
it's, well, technically, it's going across the portfolio,
Okay.
but longer term, bigger picture, any overweight in private equity, we will aim to offset with an underweight to public equity and vice versa. There's another slide in here, I'll take you all through, because
Okay.
so that rebalancing decision.
Yeah.
Because of how many liquid asset classes there are, we tend to look at things at the greater bucket level, growth, income, and stability.
Yeah.
Although you had a question.
Maybe you'll address it later on. You had mentioned that we were in a negative flow, but if I'm looking at the value of the fund
Sure.
and it's close to 13 billion. At the benchmark where I believe 1.3 billion would be in investments. You got 400 million coming in from the state plus the employee contributions. And I may be operating on old data, but I was once told that our benefit package is about $1 billion. So you're essentially almost double that without the employee contribution. So I'm just wondering, and I'll ask you later on the value of the fund, percentage, but I'm assuming you're going to address that. So how are we negative?
Yeah, so, and there may be an opportunity, Andrew, for you to chime in here as well. But to simplify, and even looking at the ACT from this most recent year, you can see that benefit payments out of the fund totaled what, 1.1 billion, somewhere in that ballpark.
Yeah.
And contributions, employee and employer contributions into the fund totaled what, 700 to 800 million, somewhere in that range, probably oversimplifying some things, but that's a negative cash flow position. And every month we get a call from the folks over in this office. My team, we work up in the DOA across the street from the State House, but every month we'll get a call from this team saying, hey, we need this much cash in order to meet our benefit obligations, and we have to take some of the portfolio. And
But what I'm saying is the investment return on that portfolio
Yeah.
is in excess of 300 to 600 million dollars, in excess of that 1.1.
absolutely.
But
So-
some years the investments will go down.
I know,
So we'll talk
don't
about-
get into smoothing.
so-
I'm just talking about the
No,
past year.
so-
when it was
generally,
bumped on the bottom.
Stacy and Heidi had come in and make payroll during the state of emergency, which they did, and thank you. And that payroll was right around $93 million that went out. And what came to us from the state that month was well less than $93 million. So, we have to use investment money to pay that bill.
Well, I understand that totally, but I'm looking at the investment returns. Plus the $400 million from the state is almost double what the cost is for benefits. Not including the employee contributions. You're talking a rate of return of 1.3 to $1.6 billion, depending if you're using the 8% benchmark or the rate of return of 12.5. That's a hell of a lot of money. That's in excess of the cost. And that's what I'm trying to say, and bear with me because of my voice. 1.1 billion going out in benefits. You got $400 million coming in from the state, but you've got 1.3 to 1.6 billion coming in from Justin, who's doing a great job over there. And I'm looking at, that's a lot of money in excess of what the requirement is, in excess of the sunk cost. That's what I'm looking at. Do you understand where I'm going?
I think we should move on to Justin and say.
Exactly.
That is the case when the investments are going up.
And we're still at 6.
The last rate of the last year, our website, and it's dated it's 31 December, has a rate of return of 12.5%. That's a hell of a lot of money.
We'll talk more about it. I totally understand the point, and the fund's growing in value because the investment returns have exceeded the negative cash flow. So
Which
if the-
gets us closer to 70, 80, 100%.
Exactly.
Which is another point that I'll
Yeah.
ask on the percentage. I'm not sure I should address that to you.
Yeah.
Or to Justin, where do we stand? Because as I said, our website lists 31 December. We're 2 months past that, and the market has gone up spectacularly since then. And that's where I'm looking is
So,
we need to operate on real-time data or as close as we can to it.
So I'm not disagreeing with that whatsoever. I'm gonna jump to another page. I'm gonna skip a different rebalancing page, but helps explain how we will also use derivative instruments to minimize the physical trading required to get our growth, income, and stability allocations back to target. But just to jump into the performance page here, I have on slide 16. Maybe a little harder for me to read, but one thing I do want to say is, yeah, in recent history, this 1 year period ended December 31st, 2005. This will earn 12.5% net of fees. I'm looking at the very top row. The very top row here is planned performance. All of the longer time horizons, any time horizon 1 year or longer that you see on this page, that reflects annualized returns. So annualized returns, it's a geometric average, not an arithmetic average, and a geometric. What does that mean? That means it takes into the account the effect of compounding. So if you have $100 portfolio and it earns 0% in year one, it's still $100 after year one. Then in year two, it earns 21%. And it goes up to $121. So you've earned 21%. So the average arithmetic return of 21% and 0% is 10.5. Geometric, what is your average return factoring in compounding? It's not 10.5%, the average is 10%. Because if you start with $100 and you earn 10% in the first year, that $100 becomes $110. You earn 10% on that, that $110 becomes $121. So you have that same outcome. The average annual return, taking into account compounding, is 10%. So it's actually less than the arithmetic average return of 10.5%. Complicated, well, ish math, but that's the point, to demonstrate what these longer time horizon returns actually represent. And going out for the trailing 15-year period, which includes this recent period of really strong performance, the annualized average return for the plan, you can see there, is 8.09%. So still strong, well above our assumed rate of return. However, if you look at the inception figure in the next column, which is just the inception of the data at our custodian bank, which is mid-2000. Now, that not only factors in this recent period of very strong performance, but it also includes some stress periods, like the global financial crisis and the dot-com bubble, as I've said before, and even factoring in the strong recent performance, the annualized return since mid-2000 is 6.2, below our assumed rate of return. Now, yes, a lot has changed in this office since 2000, over the past 26 years. And I think that this body, State Investment Commission, are both operating really strongly. And I think the investment operation today is very different from what it was 20 years ago. Regardless, the point remains, financial crisis can materially impact returns. Am I predicting that we're going to experience one? I don't know. I don't predict anything. But the point is that there, yes,
What is the most realistic in your mind? On the compounding or
Mhm.
versus, what do you think? How do you look at it?
yeah, so, and I'll talk more about this in later on, but we work with our general investment consultant, which is currently Makita,
Mhm.
to conduct asset liability studies every few years, or if we experience a material shift in market regime with rapidly rising interest rates, or there's legislation on the liability side that changes how liabilities work. And then we'll reevaluate the portfolio and say, okay, what's the right mix of equities and fixed income for us in order to meet our longer term objectives? So in order to do that exercise, you need a lot of inputs on the asset side, and those inputs are called capital market assumptions. What you expect US stocks to do over the next 10 years from a return, volatility, and correlation perspective. Same goes for all the other asset classes. Makita just went through this exercise with the SIC, and they their long-term expected returns apply to our existing asset allocation. Net of fees comes out to about 6.7%. Now, that's just data. That doesn't include any potential alpha, the value added by actually selecting good investment managers that will outperform their benchmarks. But just from a beta perspective, 6.7 is what the expectation is that our portfolio, and just.
But that's the most realistic. Wait, okay.
And I just add one point. One additional great reason we're doing this today is that we'll review capital market assumptions in May as well.
Exactly. So again, I can't predict the future, but that's why we build a long-term investment strategy that's again designed to balance those objectives of pursuing a return and mitigating risk, given the characteristics of the system itself. So how are we doing on time, Andrew? Because again, I could speak for hours.
We're good. Yeah, I think you about 15 more minutes and then we
Okay.
kind of wrap this section at 10:30.
Sure. So maybe I'll jump into performance then. I'll try to hop around as to the best of my ability. I explained what the different time horizons mean on this page, but I want to help you just understand what some of these figures mean. The performance pages that look like this in our SIC book, they're divided really into two sections. There's this singular page, which demonstrates performance at the bucket level. So we have, again, global equity and private growth. I'm trying to do this laser pointer thing. I can't figure it out. So I'll just articulate to the best of my abilities. There are gray rows and then some blue font rows. The gray rows represent our actual investments, whereas the blue, those represent benchmarks, what we're comparing our actual investment performance to. So the gray, the very first gray at the top is total plan, pretty self-explanatory. It is up there. The next two gray bars, global equity and private growth, those represent our growth bucket allocations. Following that, you have your income bucket. And then the bottom three gray rows on this page is crisis protection, inflation protection, and volatility protection, remember, those are the subcomponents of the portfolio's stability bucket. Going back to the top of the page in that total plan, you'll see that as of December 31st, the plan's market value was 12.8 billion. Now, I don't have January 31st performance report yet, but I do know where the fund landed in January. It returned about 1.7%. The market value exceeded 13 billion, which was great. We all high-fived and celebrated for 20 seconds. And then, of course, after the recent events globally, we fully expect that our value is below 13 billion. Regardless, the trend continues to move in the right direction, which is up. So you can see over that trailing 1 year period, and this is all net of fees and expenses. I know that's a very important topic, especially when it comes to investment management. Net of all fees and expenses, the 1 year return for the year ended December 31st, 12.5%. That's a great outcome. It's about aligned with our strategic benchmark return of 12.51%. I would argue that 12.49 and 12.51, that difference is statistically insignificant, especially over a short time horizon. But you can see that directly under that strategic benchmark, we have the 60/40. Now, 60/40, this is a purely passive, publicly traded instrument portfolio. 60% global stocks, 40% bonds. I'll talk more about how our portfolio behaves in relation to a simple 60 portfolio over the long run later on when I start to talk about the peer relative information in this packet. But you can see over the trailing 1 year period, this fund underperformed a traditional 60/40, which returned 16.2 billion. And they asked, like, why even bother investing in anything else but stocks or bonds? Why even have a diversified portfolio? As you look out over the longer time horizons, let's go to 10 years, for example. That's the total plan returned 9%. A simple 60/40 portfolio returned 8%. And remember, that's annualized, so per year. So 1% of outperformance generated on average per year over the past decade, which is meaningful on a $13 billion portfolio. Now, when things are pointing straight up as they did over the year of 2025, we're not going to keep pace. Remember, I spoke about diversification in the portfolio and the need to balance those competing objectives of pursuing returns and mitigating risk. We're a diversified portfolio. So when everything's going up, we're likely underperform. But what this has led to over the long run is outperformance, because as you go through time periods like 2022, and like I said earlier, in fiscal 2022, this 60/40, I want to say was down over 13%. Our portfolio was only down 1.5%.
It's the tortoise and the hare.
Exactly.
Yeah.
We are the tortoise, and
Yeah.
that's okay. So back to just how to read the report. After that broader singular page that describes the performance of our buckets, we'll actually break that down in more detail and illustrate the performance of the underlying strategies. Each of those underlying strategies, so in public growth or global equity, which is our stock portfolio, we're not buying and selling stocks ourselves. We hire investment managers. In the case of this public equity portfolio, it's State Street. And within that State Street relationship in the equity portfolio, we have multiple accounts. There's a Russell 3000 index fund, an EFI index fund, which is Europe, Australia, Far East. There's a Canada index fund, an emerging market index fund. So it's multiple accounts. So all these buckets that have now been subdivided 4 or 5 times are subdivided an additional layer, which you can see illustrated on this page. The only asset classes that are not broken out by investment manager on these pages are our illiquid asset classes. Private equity, you can see the second to last gray row on this page. It's expressed as a singular line item. That's because we have nearly 100 private equity managers in the portfolio. We have separate pages later on in the book that list every single one of those funds that we're invested in, how they've performed, what sort of cash they've given back to us. Way too much detail to be included on this page, but we do publish all of that information regardless later on in different sections of the SIC book. Are there any questions about the performance, reports here before I jump into a little bit more granularity? Is everybody still awake?
We're here.
Okay.
We're here.
Good. Well, not so good. Like I said earlier, investments really should be more. If you're falling asleep, it means that we're doing our job. One of the common topics of discussion is this public versus private market dynamic. There's a lot of scrutiny around private markets because of the lack of liquidity, the fees, which is why we invest in private markets, and I would say relatively small doses. You see our private equity exposure relative to public equities or stocks is small. Our target to private equity is 12.5%. Our target to public equity is 40. It's 40%. Again, also as a cash flow negative fund, we have to be conscious of our overall liquidity picture and make sure that this fund can withstand a market sell-off and still make benefit payments, even in stress market environments. But as of late, public equities have meaningfully outperformed private equities. So that criticism is something that's getting louder and louder. And it's not something that we can ignore as markets clearly shift. But if you look at the third gray row on this page, global equity, you can see that over the trailing 3-year period, this global equity portfolio has earned 21.2%. It's a remarkable annualized return for a 3-year period. You can see our private equity portfolio over that same time period has earned 7.2, meaningful underperformance versus our publicly traded, indexed, liquid, low cost public equity exposure. We're long-term investors. As you look out over longer time horizons, even jumping to the 5-year period, our public equity portfolio, again, that third gray row, I wish I could figure out how to use the laser pointer here. Maybe it's this button.
Okay.
Wow, look at that. This 5-year number for public equities plus 11.8%, also fantastic. Compared to private equity over that time period, 16.4% return for private equity. So despite this period of underperformance, our private equity portfolio, net of fees, has outperformed our public equity portfolio. Will this continue? I don't know. But to date, snapshot in time here, our private equity exposure has an investment performance. It's been additive to investment performance relative to our public equity exposure. But again, it comes at a cost. These strategies are more expensive to invest in, and it's not easy to get your money out once you put it in. Private equity isn't the only area of the portfolio in which we have exposure to the liquid alternative asset classes. On the next page here, page 19, which has the performance of the income bucket and its sub buckets, you can see that at the very bottom, that bottom gray row in the portfolio reflects private credit. Now, there's been a lot of headlines recently surrounding the topic of private credit. Now, do you all have any familiarity with the recent headlines about private credit and some of the investment managers out there like Blue Owl or BlackRock HPS? All right, I'll give you the simple, I'll try my best to simplify the simple rundown. But private credit, it's basically at its core lending to corporations outside of the traditional banking or fixed income or public markets. So private credit has grown tremendously as an asset class since the global financial crisis.
Is that more of a short-term investment for a company?
It's still longer term relative to other more liquid strategies. When we invest in private credit, our capital is generally locked up as well. But that question has generated or really related to a lot of the headlines that we've seen around the mismatch in liquidity between some of these investment vehicles and the underlying investments themselves. But private credit has grown a lot since the GFC, because post GFC, there's been a lot of regulation on banks, increased capital requirements, and it's become a lot harder for banks to hold loans to smaller, highly leveraged companies on their balance sheet. So to fill that void, a lot of these private credit funds popped up, making loans to these sorts of companies. Now, a lot of people at first, or private credit was pitched as, hey, this is actually better for lending to these businesses, because with banks, there's a mismatch in liquidity. You have short-term deposits funding longer-term liabilities, whereas these private credit funds that act sort of like private equity, you have locked up institutional capital, pension funds, endowments, insurance companies. And now there's a match between the assets funding these liabilities. Well, private credit has exploded over the past decade plus. The size of the private credit universe, I think direct lending in particular, we went from hundreds of billions post GFC, a big number, to now in the trillions. And it's generated so much interest, so much profit for a lot of the alternative investment manager universe, and access has been offered to a lot more retail investors. And recently there's a headline about Blue Owl, which is a manager we work with, by the way. And they actually had a semi-liquid vehicle. So again, this kind of goes against the concept of asset liability, liquidity match, but they had a semi-liquid vehicle marketed more towards retail investors. And as we've seen more stress around the sectors like software, thanks to AI, and investors wanted to take advantage of this semi-liquidity and withdraw money from this Blue Owl vehicle, Blue Owl had to essentially gain redemptions, prevent a run on the bank. They didn't handle it in the best way, and it's created a lot of headlines and negativity around this. I will say our exposure strategies like that, or to vehicles like that, is limited. We're in institutional drawdown investment vehicles where our capital is locked up and we're not necessarily subject to runs on the bank. Also in the private credit world, there's been news about fraud and something called double pledging of collateral, where a lender who's working with multiple borrowers would pledge the same piece of collateral to give the borrowers without their awareness. And some of the borrowers that made headlines in this, or sorry, lenders in this case that made headlines are really big brand name firms. And it just makes you wonder. Now, I'm not accusing anyone of anything, but when tons and tons of capital flows into a space, a relatively young space like private credit, that has produced good returns relative to liquid markets, as you can probably see on this page. But it makes you wonder, how are these players missing things like double pledging? Are they cutting corners because now so much capital is flowing in and they just have to put capital to work? It makes you wonder. So there are a lot of headlines. The bottom line for Rhode Island and what this means, private credit, while it has generated performance, you can see on this page, the 5-year return of 9.3 exceeds the liquid credit high yield exposure that we have in the portfolio significantly, which has only returned 4.7% over the trailing 5-year period. So significant outperformance from private credit. We've still maintained relatively small exposure. Our allocation in private credit it has been for a long time, in that 3% ballpark. So we've been, while private credit has been additive, we've been more cautious as to how we deploy capital to that space. And then Blue Owl, who's been in the headlines, I mentioned them because we do have some exposure to Blue Owl, primarily through their business development company. We have about a $40 million position in their private direct lending business. Additionally, Blue Owl being the behemoth that they are, they've grown a lot of their other businesses through acquisition. And we have about 80 million of exposure through Blue Owl, thanks to acquisitions. When I say that, I mean, we invested like $40 million in a data center real estate fund that was previously managed by an organization called IPI. After we invested, Blue Owl acquired them. So we have about 120 million of exposure of the market value to Blue Owl, who's been in the headlines, and worth letting you know. And private credit more broadly.
Just say for $40 million investment, you have $120 million asset.
So no, it's multiple slugs of investments. But private credit has been and is the topic du jour. Given we have a line on the page that says private credit, I thought it would be worthwhile to just talk to you all about that. All right, so again, if you go through this, the rest of the performance page, the next page, it talks about the stability bucket and the performance of much of the line components of that bucket, and crisis protection, inflation protection, so on and so forth, and then the managers that underlie those strategies. For each strategy, we'll have a segment mark, that's the little row that you see that represents, in most cases, the investable opportunity cost. If we didn't allocate capital to this manager and we simply passively indexed, what would our return have been? Have we added value through picking managers actively? Or would we have been better off simply indexing and not spending on managers? To date, manager selection has been additive to portfolio returns.
So I kind of want to pause this if any of the board members have any questions. Maybe just to end a little bit after this slideshow, there's a lot of misconception about fees and how much fund pays and fees. Maybe we can end on that.
Yeah, and that's a good point, Treasurer, and I'll start with that. I'll pick up right there. Because these are an important part of the investment decision. We talk about that in our investment policy statement. Again, recommend you all take a look at. Much more interesting than anything I have to say. But one exercise that we do on an annual basis, we're approaching that time of year right now, is we publish all of the fees paid to our investment managers across various asset classes. And we go beyond just the individual line items like private equity, let's say, which has the highest fee burden in the portfolio. We list out all the managers and what we're paying them as well. So the 100 private equity managers in the portfolio, we list what we're paying those folks. In many years, like you'll see the fees in the ballpark of 150, 180 million. What we do with our fee reporting is we break down our fees into categories. There's the investment management fees, how much we're just paying the manager to actually execute the strategy. And then there are performance fees, which I like to think more of as what percentage of the profits generated by this investment manager are they keeping versus how much do we as the investors get to keep. And in most cases in private equity, we'll say the performance fee is 20%. So if they earn 100%, $100 on their $100 investment, well, they keep 20, we take home 80.
Now, is that on top of paying them to do what they're doing?
Yeah, it's less, the management fees are taken into account first.
Okay,
So they're pulled out of any.
gotcha.
It's not essentially a double layer of fees. But we'll post all of that on our website. And it's very important that we disclose what we're paying to the folks. And in a lot of cases, when you see a high fee burden in private equity, you can see that oftentimes the higher fee is correlated with stronger performance. And like I showed before, private equity, expensive asset class. To date, on what it has been additive to portfolio performance. And that's another reason why when it comes to publishing our performance, there are a lot of institutions out there that publish their performance on a gross fee basis. We'll only publish our performance on a net fee basis. You'll never see in the SIC book gross of it, which we always factor in what the fees are. And the peer universe that you see on the screen, I just jumped to that slide. Well, this is not published in the SIC book. We should share it on a semi-quarterly basis. There are many different peer universes out there. A lot of them are gross of fees. This is the one that we choose to use because it's the net of fee first. So it factors all of that into account. These are an important part of the investment equation. And to ignore it would be a big mistake. Is that Treasurer? Is that sort of what you're getting at with investment fees there?
Yeah.
So now I'm assuming, right, so there's probably a good guesstimate based on historical data going on, like what about what your fees are going to be. Do you build that into the investment strategy to try to cover the loss on some of the fees over a course of time?
Well, every assumption that we build in to our modeling exercise, especially right now as we're going through an asset liability study, fees are incorporated. We include that in the return. Everything has to, especially when you're talking about, you know, a 20% performance fee on a strategy like private equity.
Gotcha. So it's gotta be worth it.
We hope so.
Yeah.
Again, knock on wood. Sometimes it's not. The
Yeah.
past few years, it absolutely has not been worth it. It's been terrible. If only I could predict when public markets would be better than private markets. And if only I had the ability to take $13 billion and seamlessly move it in and out of different strategy types, it would be great. But lately, it's been a bad decision. Over the long run, paying fees for the asset class like private equity has been beneficial and additive to performance. We hope that that will continue as we as investors demand a return premium if we're going to be paying more in fees and locking up our capital for a longer period of time.
Gotcha. Thank you.
Yep, absolutely. The final thing I'll leave you with is the performance pages, which again, are published on a net of fee basis. We receive these from our investment consultants. It comes from this third party aggregator called Investmetrics. You see the label on the top of the page. And this specific sheet right here compares our fund's investment performance to a universe of public pension plans with greater than $1 billion worth of assets. You can see on this page, the very bottom row with data is population. That's just the number of funds included in this universe and this information. And it shows performance over various time horizons. I'll tell you that a high number in percentile terms here is bad. Low is good. I have to give this disclaimer, and I say this every time I show anyone your performance reports. The goal of this is not to pat ourselves on the back, say that we're better than everyone else, because we're not. Every pension fund is different. They have a unique set of characteristics, different liability and cash flow profiles, and different risk tolerances. So all of our portfolios are going to look a little bit different. What this does is it gives us a good mechanism for explaining how our portfolio is expected to and has behaved in different market regimes relative to our peers. So over this 1 year time horizon, the second column of data here, our plan, again, as you know, returned 12.5% net of fees. Where did that rank relative to the rest of this peer universe? The parentheses next to it will show you that ranked 74. That doesn't mean 74 out of 113, although I guess it would be pretty close. It's the 74th percentile of the universe. So we're in the bottom 26% of plans in terms of performance for that 1 year time horizon. Again, this demonstrates how our portfolio is positioned to behave. When a traditional 60-40, which returns 16+% over this time horizon, is going straight up, we're not going to keep up, and we're probably going to underperform our peers. As you look out over time at the longer time horizon, you can see that our peer relative performance is actually quite strong. Top 10 percentile, oh yeah, the laser. Top 10 percentile over the trailing 5 year period. Top 16 over the trailing 7 year. Top 20% of public pension plans in terms of performance over the past decade, which is quite strong. But again, the goal is not to say, hey, we're awesome. It's to say the structure of our portfolio has resulted in this outcome. If you try to better understand why we've outperformed over those longer time horizons, you can sort of look to the next page that I've included here, which rather than look at multi-year periods, it actually divides. It just shows you what the past 6 fiscal years have looked like from a performance perspective. So fiscal 2025, 8.4% sounds great in absolute terms, well ahead of our actuarial assumed rate of return, but in the bottom 10% of public pension plans over that fiscal year. Again, this is a period where you can see that 60-40 portfolio, passive stocks and bonds returned 12, a really strong year for stocks for publicly traded assets or all asset classes, real. And in that environment, we're going to underperform. But fiscal 22, I said it before, and I'll point to it again. A traditional 60-40 portfolio declined 13.4%. The median public pension plan in the universe here declined 6.3%. We only lost 1.4%. we were able to better protect on the downside during this period of fiscal 2022. It's periods like that that are primarily responsible for driving our outperformance, relative outperformance on over these longer time horizons that you see on the page here, because 5, 8, 10-year periods include that fiscal 2022 when everything was pointing downwards and we were able to provide protection on the downside. I want to just leave you with one final thought, if that's okay, as we talk about performance and expectation for the future here. If I can figure out how to get back to the SIC book, which I think I did. You know, I do these at the SIC meeting, so I should know how to use convene at this point. But one thing I want to show you is in our SIC book, our consultants will generally produce some slides that include broader market commentary, performance of assets broadly. And one thing to note here is this market update slide. It looks at performance for a variety of different asset classes over some relatively short time horizons, only going as long as 5 years. But if you look at the S&P 500, the trailing 3-year return for the S&P 500 US equities, 22.5% annualized. So every year for the past 3 years, this index has returned 22.5%. Remarkable outcome. If you were to chart rolling 3-year returns for this index going back to inception, this would rank. This is a 99 percentile. Or in, I guess, in the peer performance terms, a 1 percentile outcome. Doesn't mean it can't continue. It certainly can. Like, there are a lot of things in the world that are changing, but just to level set and explain that what we've experienced over these past few years is very different from what has been experienced by the broader marketplace beyond these 3 years. Again, why we continue to maintain a focus on risk awareness, while a lot of our other colleagues may be pushing more assets or more of their capital into risk assets, chasing returns. It's not something that we try to do at Rhode Island. I'm happy to answer any questions now. I want to be an open book. As you know, Aldo, if you ever have any questions in between meetings, definitely feel free to ask and route them through Andrew, and he'll make sure that the questions get to the right folks on my team. But we definitely want to make sure that we're working together, SIC, retirement board, and if there's any information, ask.
I'm just looking at the data.
Yeah.
And I know the GRS annual report was as of 31 December, but I believe it was based on the report of 30 June, the close of the fiscal year. And I'm looking at, I don't like using old data. That's almost 8 months ago. And on 30 June, the Dow Jones closed at 44,000. On 31 January, it closed at 48. That's a 4,000 point difference. And I'm just looking at trying to get the latest data up on our website, because members of the system look at what's on the General Treasurer's website and they see 31 December and they start questioning things. And he knows it's better than that. I know it's better than that, but they don't know that it's better than that. So I think we need to, update it a little better. And I'll have my other questions will be for director as we progress.
On the value portion, absolutely agree, especially when it comes to not having the January data up. And again, that's a function right now of a tiny little piece of our benchmark requiring correction from our custodian bank, BNY Mellon. We expect that to be corrected in the coming days, at which point we'll throw the January figures up there. But when the month ends, it takes a little bit of time for accounting to close, performance to be calculated, then our consultants have to produce the package. And once we present it to the SIC, that's generally when the book will go on the website and the numbers will be updated to reflect more current market values. As you know, and I've said, these things fluctuate. Markets go up, markets go down, and also we're paying money out of the fund, so it's a bit of a moving piece. And I know that when you all do your work with your actuaries, the same way that we do our work with the general consultant, we're looking at the long-term, bigger picture. It's hard for us to make actionable decisions based on short-term market fluctuations.
It's always been a core belief that it's important for the ERSRI to know how the work of the SIC impacts this board and vice versa. And so Justin and Andrew have been working really hard to integrate the material and the information so that you guys are better versed. Same with the SIC.
I think I spoke for closer to 2 hours than a half an hour.
Yeah.
But thank you. Justin and his team is doing a really good job and he's very accessible, as you mentioned. Thank you.
Thanks, everybody.
Thank you.
Thank you.
Thank you, Andrew. I will now seek the approval of the February 2026 pensions as presented by ERSRI. So moved. Second, all in favor?
Aye.
Right, approved. Legal counsel report.
Thank you, Treasurer. So you have the reports in the convene. The one matter I'd like to just draw your attention to is the Patricia Dubois matter, which is at the bottom of page 1 on our report. And recognizing sometimes I use legal terms in here and might not be as familiar. The Supreme Court did grant her petition for writ of certiorari. All that means is it's now before the Supreme Court to hear her appeal. Because it's an administrative appeal, she doesn't have a direct right of appeal to the Supreme Court, which is why she had to file the petition for writ of certiorari. But the Supreme Court granting that, it merely means that they now consider the appeal on the merits and will be briefing that going forward. So it's not as if the granting of the petition is the Supreme Court granting her appeal. It just allows them to consider it. So I just want to make that clear for the board, because realize sometimes when I use the legalese in these reports, it might not come across.
Any questions for legal? No, all right, thank you. I'll call on Dr. Shaw Hughes for the disability committee report.
Thank you. I'll make a motion to approve the disability committee recommendations from our March 6th, 2026 meeting.
Motion, second by Andy. All in favor?
Aye.
Any nays? So moved. Last. Anything else? Any big business office, all right. Seek a motion to adjourn.
Motion. Well,
I have 2 questions.
Yes.
And because I get a lot of input, one question is for me personally on the report for who was in arrears and contributions. I noticed that Central Falls and East Providence had been noted as be behind. Are they all up to date now with their contributions to the system?
So the initial report, I believe, one of Central Falls plans still has Sunderland Z, but there's no structural problem that should be moved.
And one other point, just to put it at rest, as I say, our group is like herding cats. And someone raised the issue of, well, raiding the pension fund to pay for the blizzard recovery. And I said, over my dead body, I just wanna, get your point and put it to rest and get it over with. That way you're on the record and it won't happen before this board is notified of any attempt at that.
So. One, I have two points. One, this is not on agenda, so probably does not merit much discussion. But is like central to all of our operations that we are segregated accounts that no one has to see, right? Like they can't like pay ours to no. There's
So the technical answer is no.
it's a no. There's no.
On the record, people know.
There's no,
Well, you
there's no
put
way
it
to
on
do that. You're okay.
Exactly, but that's the rumor that's out there, and I just wanna put it to rest, so nobody gets harassed on it.
Good, so we have a motion and second, all in favor to adjourn?
aye.
He's adjourned.
Thank you.
Wow.